Imagine waking up one morning, checking your bank account, and noticing something unusual. Not a withdrawal you didn't make, not a fraud alert, something quieter than that, but potentially far more serious. A letter from the IRS, and it's asking questions about your money. That's not a scare tactic. That's something that has already happened to thousands of ordinary Americans, retirees, seniors, people just like you, who had no idea they were doing anything wrong. They weren't hiding money. They weren't cheating on their taxes. They were just keeping cash in their bank accounts the way they always had. And suddenly they found themselves in the middle of a financial nightmare that took months, sometimes years, to sort out. So today, I want to talk to you about something that almost nobody in the retirement community is discussing openly. How much cash you keep in your bank account in 2026, and why that number matters more than you might think. Not just for your taxes, but for your Social Security benefits, your Medicare, and your overall financial peace of mind. Stay with me because what I'm about to share could genuinely save you from a very stressful situation. Let's start with something most people have never heard of. It's called a Currency Transaction Report, or CTR. Here's how it works. Every single time you deposit or withdraw $10,000 or more from your bank account in a single day, your bank is legally required to file a report with the federal government, automatically, without asking your permission, without even telling you in most cases. It just happens. Now you might be thinking, okay, I don't move $10,000 around very often, so that probably doesn't apply to me. And that's exactly what most people think. But here's the problem. The rules go much deeper than that single $10,000 threshold. And this is where a lot of seniors get caught completely off guard. There's another rule, and this one is the one that really surprises people, called structuring. Structuring is when a series of smaller transactions are made in a way that appears designed to stay under that $10,000 reporting limit. And here's the thing. You don't have to be intentionally trying to avoid the limit for it to look that way to the government's automated systems. Let's say you deposit $4,000 one week, then $3,000 the following week, then $2,500 the week after that. Every one of those transactions is perfectly legal on its own. But when a bank system, or the IRS's monitoring software, looks at the pattern, it can flag your account for review. This is sometimes called a Suspicious Activity Report, or SAR. And once one of those gets filed, your account activity can be under a microscope without you ever knowing it. This isn't a hypothetical. The IRS and the Financial Crimes Enforcement Network, that's FinCEN, have access to billions of transaction records every single year. The technology they use to scan for unusual patterns has gotten incredibly sophisticated. And in 2026, with the government under more pressure than ever to close what they call the tax gap, which is the difference between what Americans owe in taxes and what actually gets collected, the scrutiny on everyday bank accounts has never been higher. Now, I want to be crystal clear about something. Having money in your bank account is not a crime. Saving money is not a crime. Depositing your Social Security check is not a crime. What I'm talking about today is understanding the environment you're operating in, so you don't accidentally trigger a review that causes you enormous stress, delays your benefits, or creates legal complications you weren't expecting. Let me tell you about a situation that a lot of people in their 60s and 70s find themselves in. Maybe you sold a piece of property. Maybe you received an inheritance. Maybe you've been setting aside cash for years, keeping it at home, the way your parents' generation did, and now you want to put it in the bank for safekeeping. Completely understandable, completely reasonable. But when that money suddenly appears in your bank account in large or irregular amounts, it can raise red flags with automated monitoring systems that have no idea what your story is. And that's the key thing to understand. These systems don't know you. They don't know that the $8,000 you just deposited is from selling your car. They don't know that the $5,000 you withdrew last month was for a family emergency. They just see numbers and patterns. And if those patterns look unusual, they flag it. So what does the IRS actually look for? Let me walk you through this, because understanding it gives you real power. First, they look at deposits that are inconsistent with your reported income. If you're retired, receiving Social Security and maybe a small pension, and suddenly there are large deposits showing up that don't match that income picture, that can trigger a closer look. Not necessarily an audit right away, but it puts your account into a category that gets more attention. Second, they look at frequent large cash transactions. If you're regularly dealing in cash, and some seniors prefer cash, there's nothing wrong with that. But if those cash transactions are frequent and large, it creates a pattern that monitoring systems are trained to notice. Third, they look at accounts that suddenly become very active after a long period of minimal activity. This comes up a lot with seniors who have had a savings account sitting quietly for years and then start moving money around more frequently, perhaps because of a health event, a change in living situation, or estate planning. Fourth, and this is one most people don't think about, they look at large transfers between accounts, especially transfers to accounts in other people's names. If you're helping a family member financially, which many grandparents and parents do, large transfers that aren't accompanied by clear documentation can look suspicious to an automated system. Now here's where this gets really important for your Social Security and Medicare specifically. Most people know that Social Security has income limits for people who are receiving certain types of benefits, particularly supplemental security income, which is SSI. If you're receiving SSI, there are strict rules about how much money you can have in your bank account at any given time. The current resource limit for SSI is $2,000 for an individual and $3,000 for a couple. That's it. And bank account balances count toward that limit. If your balance goes above that threshold, even temporarily, you could lose your SSI benefits for that month. Now, regular Social Security retirement benefits don't have this same resource limit. If you're collecting Social Security retirement based on your work history, the amount in your bank account doesn't directly affect your monthly payment. But here's where it gets more complicated. If you're also enrolled in Medicare savings programs, those are the programs that help lower-income seniors pay their Medicare premiums and cost sharing. Those programs do have asset limits in most states, and bank account balances count. So if you've accumulated more in your bank account than you realize, and you haven't reported that accurately, you could be receiving assistance you're no longer technically eligible for. And when that gets discovered, and these days it often does get discovered, you may be required to pay back benefits going back months or even years. That's a situation nobody wants to be in, especially on a fixed income. If you're finding this information helpful and you want to make sure you're protected going forward, take a second right now to like this video and subscribe to the channel. We cover these kinds of real-world financial and benefits topics every week, the stuff that actually affects your life but that nobody explains clearly. Hit that subscribe button so you don't miss anything important. Now let's talk about what I think is the most overlooked piece of this entire conversation, and that is the question of where you actually keep your money, and how much liquidity is the right amount in a checking or savings account. Financial advisors generally recommend keeping between 3 and 6 months of living expenses in a liquid, accessible account. For most seniors, that might be somewhere between $10,000 and $30,000, depending on your monthly expenses. That's a perfectly reasonable cushion to have available. It covers emergencies, unexpected medical expenses, home repairs, or just the peace of mind of knowing the money is there. But here's what I see happen with a lot of seniors. They accumulate much more than that in their checking or savings account, sometimes because they don't fully trust investing, sometimes because they've been through economic downturns and feel safer with cash nearby, sometimes just because they haven't really thought about whether there's a better place for it to be. And when that balance grows very large, we're talking above $100,000, a few things start to happen that you should be aware of. First, FDIC insurance. The Federal Deposit Insurance Corporation insures bank deposits up to $250,000 per depositor, per bank, per ownership category. That means if your bank fails, which doesn't happen often but does happen, deposits up to $250,000 are guaranteed by the federal government. but anything above that is at risk. A lot of seniors don't realize this, and they keep all their savings in one account at one institution without ever thinking about what happens if something goes wrong. Second, large bank account balances are visible to the IRS through what's called third-party reporting. Banks report interest income to the IRS. If you have a large balance and you're earning interest, even the modest interest rates available today, that interest has to be reported on your tax return. Most people know this, but what some people don't realize is that any interest you earn can affect how much of your Social Security is taxable. This is a really important one. Up to 85% of your Social Security benefit can be subject to federal income tax, depending on your total income. And combined income, which is the measure the IRS uses, includes not just your wages, pension, and retirement account withdrawals, but also interest income from your bank accounts. So a large savings account balance earning interest can, without you realizing it, push you over the threshold that causes more of your Social Security to become taxable. For individuals, if your combined income is between $25,000 and $34,000, up to 50% of your Social Security benefit may be taxable. Above $34,000 and up to 85% can be taxed. For married couples filing jointly, those thresholds are $32,000 and $44,000 respectively. Now, most people focus on their wages or pension when they think about that threshold. They forget to count the interest sitting quietly in their savings account. But the IRS counts it. And if your bank account has been growing for years and you haven't checked recently how that interest is affecting your tax picture, this is absolutely the time to do it. This is where things get serious for a lot of seniors, because the combination of factors I'm describing, large account balances, interest income, irregular deposit patterns, can create a situation where the IRS has questions, and you're not prepared to answer them quickly and cleanly. Let me walk you through what the IRS review process actually looks like, because most people imagine it's immediately scary and aggressive. In reality, for most people, it starts much more quietly. Often the first contact is simply a letter. The IRS sends what's called a CP 2000 notice, or similar correspondence, indicating that the income reported on your return doesn't match what their records show. This might be because interest was reported to the IRS by your bank, but wasn't included on your return. Or because there's a discrepancy in reported income versus apparent deposits. Most people panic when they get one of these letters, and that panic often leads them to make mistakes, ignoring the letter, responding incorrectly, or providing too much information without understanding what they're being asked. Here's what you should do if you ever receive any kind of letter from the IRS related to your bank accounts or income. Read it carefully before you do anything. Identify exactly what's being asked, and if there's any doubt whatsoever, contact a tax professional, a CPA, or an enrolled agent before you respond. Do not call the number on the letter as your first step. Do not provide any documentation they didn't specifically request, and do not ignore it. That last one is the big one. Ignoring IRS correspondence makes things dramatically worse. Most CP 2000 notices and similar letters are resolved relatively simply when you respond promptly with accurate documentation. The nightmare scenarios, the ones that drag on for years, almost always involve people who either ignored the correspondence or responded without professional guidance and made the situation more complicated than it needed to be. Now let's talk about some practical steps you can take right now to protect yourself, because information is only useful if it leads to action. The first thing I want you to do, this week, not someday, is look at your bank account balances across all accounts, not just checking, savings accounts, money market accounts, CDs, everything. Add them up. Compare that number to what's documented on your most recent tax return. If there's a large discrepancy, if your balances have grown significantly and that growth isn't reflected in your reported income, you may want to sit down with a tax professional to make sure everything is properly documented and explained. Second, if you have more than $250,000 at a single institution, strongly consider spreading that across multiple banks or account types to stay within FDIC insurance limits. This isn't about hiding anything, it's basic financial safety. Third, if you've been receiving or expect to receive a large sum of money, an inheritance, proceeds from selling property, a settlement, a large gift, document where that money came from before it hits your account. Have the paperwork ready, a letter, a settlement document, a closing statement. Not because you'll necessarily need it, but because having it ready means that if questions ever arise, you can answer them quickly and confidently. Fourth, if you're receiving any income-tested benefits, SSI, Medicare savings programs, extra help for prescription drugs, or any state-level assistance programs, you need to be very aware of the asset and income limits for those programs and check your eligibility regularly. These limits don't always get widely publicized when they change, and it's your responsibility to self-report accurately. If you're unsure whether your current bank balance affects your eligibility for any benefit, call the Social Security Administration directly at 1-800-772-1213. They can tell you exactly where you stand. Fifth, and this is one a lot of people overlook, if you're managing money for a spouse, parent, or family member in addition to your own, make sure those transactions are clearly documented. Money flowing between family members, even with the best intentions, can look unusual in a financial monitoring system without the right documentation. Keeping a simple log, date, amount, purpose, can protect both you and the family member you're helping. Most people don't realize this, but there are also limits on how much you can give to someone else without triggering gift tax reporting. In 2026, the annual gift tax exclusion is $18,000 per person. You can give up to $18,000 to any individual in a calendar year without having to file a gift tax return. Above that amount, you need to file a Form 709, even if no tax is actually owed. Many seniors help their children or grandchildren financially and never think about this. But large transfers that aren't documented can create exactly the kind of paper trail confusion that draws unwanted attention. Now I want to address something that comes up a lot when I talk about this topic, and that's the feeling of resentment or frustration that people naturally experience. You worked your whole life, you paid your taxes, you saved your money the right way, and now there's a government system that's watching your bank account and could potentially cause you problems just for having saved enough? It feels unfair, and I understand that. But here's the reality. The systems that exist were not designed specifically to target retirees or seniors. They were designed to catch money laundering, tax fraud, and financial crimes. The problem is that these automated systems can't distinguish between a criminal moving illegal money and a retiree managing their legitimate savings, unless the records are clear. So, the best protection you have is not hiding anything, not keeping things informal, and making sure your financial picture is documented and consistent. Transparency is your shield. That's the single most important thing I want you to take away from today. When your transactions make sense and the paperwork supports them, the IRS has nothing to work with. It's when things are inconsistent, undocumented, or unexplained that problems arise. Let me also mention something important about inflation and what it means for cash savings in 2026. Over the last several years, inflation has eroded the purchasing power of cash significantly. Money sitting in a regular savings account earning 1 or 2% interest while inflation runs higher is actually losing value in real terms. This is one of the most underappreciated financial challenges facing seniors today, and it's something worth discussing with a financial advisor who understands retirement income. There are options that provide safety, liquidity, and somewhat better returns than a basic savings account. Things like high-yield savings accounts at federally insured banks, Treasury I bonds, short-term Treasury bills, or FDIC-insured CDs. None of these are investments with market risk. They're all federally backed or insured, and some of them offer meaningfully better returns than a standard bank savings account while still keeping your money accessible. This isn't financial advice. Your situation is unique and you should absolutely consult with a professional, but these options are worth knowing about. I want to come back to the core message one more time before we wrap up, because I want to make sure it really lands. The IRS is not your enemy. The Social Security Administration is not your enemy. These systems exist, in theory, to protect the public and make sure everyone contributes fairly. But they are also large, automated, and imperfect. They flag things based on patterns, not context. They can cause real disruption in your life if your financial picture doesn't match what their systems expect to see, even when you've done absolutely nothing wrong. The seniors who navigate this world most successfully are the ones who take their financial documentation seriously, stay aware of how their bank account activity looks from the outside, and have a trusted tax professional they can call when they have questions. Not just at tax time, throughout the year. If you don't currently have a CPA or tax professional who understands senior benefits and retirement income specifically, that's worth prioritizing. Many areas have free tax assistance programs specifically for seniors. The IRS's own VITA program and the AARP Tax Aid program both provide free tax preparation help from trained volunteers who understand the kinds of issues we've discussed today. You can find them through the IRS website or through your local AARP chapter. The bottom line is this. In 2026, more of your financial life is visible to government systems than ever before. That's not a reason to panic. It's a reason to be prepared. Know what's in your accounts. Know where your money came from. Keep your documentation current. And make sure the income you're reporting is consistent with the deposits your bank is recording. You spent your whole life building financial stability. You deserve to protect it. And the best way to protect it is to understand the rules. Not fear them, not resent them, but understand them well enough that they can never catch you off guard. That's what we try to do here every single week. Take complicated financial and benefits topics and explain them in plain language that you can actually use. If today's video helped you feel more informed and more confident about your money, please take a moment to like this video. It helps more people find this information when they need it. And if you haven't subscribed yet, please do. Click that bell notification so you know the moment a new video goes up, because these topics change, the rules change, and staying current could make a real difference in your benefits and your bottom line. Because here's the truth, nobody is going to hand you this information, not the government, not your bank, not the evening news. The people who stay financially safe in retirement are the ones who make it their business to stay informed. And you're already doing that. You watched this video all the way through. That tells me you take your financial well-being seriously, and that matters. Stay sharp, stay documented, and we'll see you in the next video.